Let's bring in our markets guest, Joost van Leenders. He's with Kempen Capital Management, senior investment strategist there. Joost, you heard Jared kind of walking us through the moves. It feels like things have been a little flat given that there's not a lot of economic data coming out driving the moves in the market. Looking at the bond yields right now, we're seeing the 10-year pushing below 1.6%. It feels like the inflation fears maybe still there, but not necessarily in the forefront.
No, that's true, and we've seen the economic data in the U.S. coming in a bit less strong than expected. So it's not bad. The data is still strong, but not as strong as analysts and economists expected. So it's maybe driving the market, taking away those inflation fears a little bit. So for now, it looks like the Fed and all the different speakers of the Fed have reassured the markets. And convince the markets that they can keep yields and rates low for a long period.
When you fit that discussion into the context of what's going on around the globe right now, I mean, how unique of a position do you see the Fed being caught in here when it comes to navigating those inflation fears and how they're doing that relative to the other central banks you watch?
Well, I think the ECB or the Fed has a bit more of a difficult task than the ECB. The Fed has sort of indicated that it will keep rates low for a very low period, and we have this inflation bout in the US that's temporary. For a large part, but we don't know for sure. But you also have that very strong economy, and an economy that has mostly recovered and grown into its full capacity. So you might see a bit more sticky inflation in the U.S. than in other parts of the world. Like the ECB, it's clear that they won't touch rates for a long period. But you have an economy which is about 4.5% below the pre-corona level, and you have much fewer inflationary pressure. So it's more, everything is more pointing in one direction in Europe than it is in the US. The Bank of England also has a stronger economy now, so you might see it's a bit in between. But the Fed has really this inflation, which it says will stay low, but the underlying strong economy, and I think that's a more of a different driver than it is in Europe.
How has that forced you to maybe shift up your portfolio? Would you say that you've sort of tried to increase your exposure to Europe a bit more on the back of those fundamentals you walked through?
Yes, well, on equities, we've been overweight European equities for a while. I think the inflation risks are higher in the US, so the risk of yields moving higher in the US are bigger, and US equities are traditionally more sensitive to yields. Because of the sector composition of the index mostly. So that's for us a preference for Europe. The valuations are also a bit higher in the US, which make them more vulnerable to rising yields. So we've had that preference. But for example, we've added some European real estate to our portfolio. That's a sector that has a large potential still for a further recovery. And in fixed income, we know when yields go up that a lot of fixed income categories are more vulnerable, and one of them is emerging market debt, traditionally quite vulnerable to rising yields. So we cut our exposure there. So basically, what we do, we have a bit of preference for Europe already in the portfolio, enlarged that, but we also think that investors should take that risk at least of higher inflation into account, and that's what we've done in our portfolio.